Right now, we're going to get into the world of venture capital. Who here is looking to raise money right now as we speak? Okay, a lot of you. Well, it's good news because there's a lot of capital out there to be had. Our next guests are going to talk about it a little bit. Please welcome to the stage from General Catalyst, Nico Benatzos, and from Coatue Ventures, Karen Maroney, as well as your moderator, Connie Loizos. Warm welcome.
Hi, good morning, everyone. Thank you for coming today and this week. A lot to talk about. We do this sort of state of VC every year, and it's very fun for me because there's always new trends that are reshaping the industry. One that I wanted to start off with today is a sort of this very big years-long trend, which is kind of this blurring of what a venture firm even really means anymore. I think it's so interesting. So Karen, your firm, Coatue, started as this hedge fund investing in publicly traded companies.
Yes.
Now it's got a growth arm, it's got a venture arm. And Nico, on the opposite end of the spectrum, you work for General Catalyst, which started as this very small venture firm in Boston and expanded into, what is now a registered investment advisor managing many billions of dollars. So, Nico, maybe I can ask you first. What is the outcome when everyone is doing everything?
Well, not everyone has earned the right to do everything. It's like we're talking about like very few firms. It's like 10, maybe 12 firms that have been capable of doing everything. In our case, we started from being an early stage firm. Early stage continues to be our core. And we learned from serving our customers, the founders, that they want to build enduring companies and they want to stay private for longer. And as a result, we felt like raising growth funds was something that could meet their demands, and we did that. And over time, we decided to become a registered investment advisor as well, because it made sense, for our business, because companies stayed private for longer. The ones, who went public could grow very well in the public market, and we could continue to be with them for the journey for a longer period of time instead of just exiting early on as we're doing in previous times. So we're all products of the times we operate in, and this has been the story of the last decade. We're ambitious as the founders that we back in, and we do care about building our own business.
And I guess, is this a trend? So as you mentioned, it's like 10 or 12 of you, Sequoia, Andreessen, Insight Partners. So you think there's a sort of a limit to how many firms are going to be doing this? I mean, I guess, is the model sustainable? Is this the new?
So, okay, I'm going to date myself. I've been in this industry for a long time, not in the venture industry, but in the tech industry. So just to literally date this, I started working with Mark Benioff when he was starting Salesforce from his apartment in Coit Tower. It was small. He was wearing sweats all the time. It was he had his co-founder in the apartment next door coding. He also had a beautiful view, but they covered it because it was messing with the screens. But this was a long time ago, and at the time, Mark Benioff could not get funding because it was a new model, and the traditional VCs were like, I don't understand the TAM, the market size. He was like, it's all app. It's like, no, it's only this. It's like, I don't understand what the metrics are. And so one very famous VC said to him, if you go on-prem, we will fund you. And he was like, okay, you totally don't get what I do. So that was a very traditional model. It was like, we do this. Then you fast forward, I worked for Facebook for many years. And I think people forget that Facebook had a down round. They stayed private for I would say we, but they, now Meta, stayed private for a really long time. And people didn't know what to do with a growth company at that size, so they did a down round, which at the time, it doesn't matter now, but it's an interesting moment in time. People didn't know what to do with them with a company that stayed private. So for years and years and years, we had no change in the venture world. It was these very status quo ways of operating. And I feel like we're now in this place of pretty interesting change. You talked about micro VCs and really niche. We have we're all sort of moving to meet the needs of the founders and the LPs who trust us with their money, that we need to be more creative. I think the thing, and we all go to like where the needs are and the environment is. And I think the thing that stayed the same is maybe the VC vest. You know, the Patagonia vest?
They're
I
still
feel like
wearing their-
that has been
right,
pretty
right.
standard, but everything else is changing.
Well, I wanted to ask, just because
Is that true? I was happy you weren't wearing one.
I mean, I've never wore one, but I read, I think that Patagonia, is no longer producing VC vests, right?
Really?
I think that happened. Maybe,
gosh.
Does
you
anybody
can
know if
use them
that's
as a gift on Slack.
Sorry, this is
no,
off
no,
topic.
no, that's okay. I was just going to say there's so much fluidity in the industry, but I do wonder if it doesn't create overlap. Like your LPs want a bigger stake in your companies. I was reading the information yesterday, and there was a story. There was an interview with the CEO of the Stanford Management Company, its endowment, and he was saying basically he can't put enough money into top firms. Like it's frustrating because they can't scale fast enough. But at the same time, they benefited hugely from being a part of these companies, but now their returns are sort of abysmal. And I wonder if it's in part because they've got stakes from all of you in the same companies, when you're sort of all converging on the same. Is that something that LP should be concerned about going forward because you are kind of all in each other's lanes, so to speak?
I personally don't see how this is different than how it used to be, right? Like if you're an LP at a top endowment today, you want to have like a piece of the top 20 portfolio of top 20 tech companies that get started every year. That could become, the next big thing. So this was the same, back then. Now the outcomes that in more recent years have been much larger than ever before. Also, some of these companies are no longer getting started in Silicon Valley. Some of them are getting started in Europe. They move to New York, open up an office there. Europe on its own now has a pretty awesome tech scene. In China, there were, over the previous decade, terrific outcomes for limited partners. We'll see what happens, moving forward. So yeah, but LPs, that's what they want. They want to invest in some top firms and get as much of a stake in the companies that are enduring and could create $100 billion market cap outcomes.
Right.
What LPs have to do, as it's been the case over the last decade, is to invest in different pools of capital that the VC firms give them allocation to. Historically, it was just invest in the early stage fund. Now you have options to invest in many different vehicles.
We were talking a little bit backstage about some of the pain that could potentially be coming down pike for startups, but I also wonder for venture firms. Obviously, firms have smartly been raising lots of funding. Again, LPs want to put as much money to work as they can. Do you think we're going to see a right sizing of the industry, going into next year?
So if I think about it, I believe that people are fundamentally rational and intelligent. So if we take it from that basis, and if you are a founder, you need to figure out, okay, where am I given this global economic environment, and what do I need to do to make sure that I ensure the best outcome for my company? Mm-hmm. So it's like, okay, we're going to see some ups and downs in the public market. We're going to see some ups and downs in IPOs. We're going to see some possible changes in the landscape. But what does that mean to you as a founder? And I think of it, I like to do quadrants for everything. I think of it as like there's 4 quadrants that a company fits into, and that sort of can help dictate what you can do. And the axis are how much money have you raised or runway do you have, and do you have product market fit? So if you have raised and you have a lot of runway and you have found product market fit, then I consider you're a healthy company, upper right-hand quadrant. That means you can ask yourself, should I hire in this environment? I would say yes. If you're in this right-hand quadrant, I would say this is a great opportunity to hire and scale and grow and take advantage. If you are very little money, but product market fit, I would call those company survivors, because you do really have a product that works, but you found yourself in a really tricky point in time. Take heart, Amazon was one of those companies. But it does mean getting creative with either cost cutting or how you're going to fund this. And that becomes very interesting and very important. But you have to do everything you can to, this product works, to make sure that your product and your company survives. Let's say you have a lot of money and you don't yet have product market fit. I call them explorers, bottom right. These people are like a typical Series A company. the important thing is to keep in mind that you don't have product market fit yet. Like, don't scale because, to Connie's point, we don't quite know where the markets are going to go and how much liquidity and capital is now more expensive. It used to be somewhat free, now it's kind of expensive. So I would say, like, stay lean and understand where you are in the product market fit journey. And then lastly, it's like the danger zone are the ones that, like, don't have product market fit and don't have capital. And those are like, you might need to pivot or rethink. So I think those all come together.
That's great. I just mean also, though, in terms of venture capital firms themselves, are we going to see them sort of shrinking or breaking up or looking different going forward?
I think they look different now. I mean, you were talking about the niche ones. You're getting, like, really specific. You're getting,
actually, to that point, I was just going to say for the audience, what we were talking about is there's a, I don't know how big a trend it is, and
I think it's interesting.
Where, we've seen funds now focusing on like oral care and fighting firefighters.
Yeah, I thought that was fascinating.
How specific can you be? But when you have these giants that are covering everything, maybe that's the only space to grow up in. And I was wondering, is that going to become a thing?
Well, it's always like a very dynamic ecosystem, and what's happening with other species, VC firms will have to go through the natural selection cycle. It's going to be the survival of the fittest. Historically, VC firms had to go through generational transition, which is like a very painful activity for anyone that has gone through that stuff. We've seen over the last few years, as you were both saying, how much the ecosystem changed. Like, we have now hundreds in San Francisco alone of very small firms, solo GPs, micro VCs. Some of them will decide to merge with each other and build like a more enduring franchise. Some of them will decide that, you know what, I tried it during the good times. VC as a career option is not one for me. We'll have to do something else afterwards. A number of the more well-known platforms that didn't decide to go multi-stage will either stay small, or when the senior partners there decide to retire, they will have to figure out what the next day is going to look like. We're all products of the markets and the times we operate in.
Right.
And that's really great.
And you have to earn the right to survive. I think it was like, oh, okay, there was some path, and then you did investments and you made money. It's like, no, you've got to earn the right, and not everybody is going to earn that right. And I think that that's healthy.
I think so too. Well, also, I think a lot of people, not having been in the industry long enough, had only seen good times. And I think that probably led in some part to what I want to talk to you next, which is what happened with founder terms. I mean, the industry, as we've talked about, is very cyclical. I mean, every, 5 years, typically things swing very much in the favor of either founders or investors. And it's been very founder-friendly for so long. But, to an astonishing degree, I was thinking about Hopin specifically, which is this virtual events company that was founded in 2019. And according to the Financial Times, the founder was able to cash out $200 million worth of shares and still owns 40% of the company, which I find mind-blowing. I'm just wondering, what happened? What happened that we got to this point?
Well, we're one of the investors in Hopin. So for
you both are, actually.
Yeah. Yeah. So for a period of time, this was the fastest growing company of all time. It's a very profitable business. Also, COVID happened, and they had the perfect product at the perfect time for the entire world.
Right.
Back then, Zoom was doing really, really well as a company. And it was the beginning of the crazy VC funding acceleration period that got started in the second half of 2020. So a lot of us got intrigued because the product looked perfect, the market opportunities seemed pretty sizable, and the company was not consuming any cash. And when you have very competitive market situation where you have a founder who receives 10 different offers, some offers need to sweeten the deal a little bit to make it more convincing.
Which,
So
you know,
that's
and
how
it's-
I think it happened. I don't know what Karen
well, nothing
would say.
against founders, but I mean, I just feel then the people who left that firm reading that story must have been, or were laid off, must have been seething, like, oh, you know, it doesn't seem just. I guess I'm wondering, you know, what happens forward? Were there any lessons learned, or will the same thing happen again? Because that's just the way it works. When there's demand, you meet the demand, you know, meet the terms that are demanded.
I think you have a lot of different plays, and it was interesting because everyone at a certain point in time was like, if I leave a company and I start a company, I am going to get funding and I'm going to be successful. And it just felt like, and that is the path. And we all know that can't be the path. And I think the people who start companies now are no longer under that like haze of everything goes up and to the right. And I think the generation of people that start now on both sides are going to be far more wide. What is it? Is it eyes wide open? There's I'm sure there's a saying, right? Clear-eyed. That's it. And I also think there was this sense of like people were saying, "Oh, I want money with no strings attached," and we, you know, like to be involved in companies. I sit on boards. We really, when the companies that we work with, we get very involved. And I think there was a period of time where every founder was like, I actually don't think I need any help. And that has dramatically changed with like, have you seen any of this before? Because I could use some help.
Sure.
So in that sense too, I think on both sides, this idea of like, let's help and be involved. And that's something I've always wanted to do. I know you do, so.
Yeah, absolutely. Like the market conditions have changed. So if you're raising a growth round today and you're not one of one company or exceeding your plan dramatically or ideally both, it's probably harder because a lot of the crossover funds or late-stage investors, they go open up their Charles Schwab brokerage account and they can see what the terms are there and they're better. They can buy today, they can sell next week. In a private company, you can't do that. At the very early stage, it's also a little bit of a function of how many funds are out there that are eager to write checks, how much capital they've raised. So at the seed stage, we haven't seen, much of a difference yet.
That's true.
Especially for first checks. If you're a seed company that raised last year, the year before, and you haven't made enough progress to earn the right to raise a Series A, now it's a little bit harder. In the previous years, you could raise a seed 2, 3, 4 round from all the firms that got started to invest in seed stage companies. Now that's not happening.
Right.
Series A, I would say it's a little bit like return to the basics. So invest in technical teams that have high margins. So if you're doing something tech-enabled, it's harder. If you're a founder who's starting a company, raising capital for a very capital-intensive business, it's going to be much harder. Are you building a business out of geo? It's going to be trickier. Like this is the kind of stuff that Zoom investing made really easy. The rounds were happening like this. That's not happening as quickly.
You know, the out of geo point is really interesting because I did think that Zoom was sort of the great equalizer, and everyone was like, "Oh, we're investing everywhere in the world now. It's great." And I've subsequently talked to investors who say, I have one in mind in the Midwest who said, actually, everybody's kind of retrenched. The Silicon Valley investors are back investing in Silicon Valley because their LPs will be frustrated with them if they miss something in their own backyard. What are you seeing? Are you kind of, what percentage, I guess, of your respective firms are you focused on, like the big hubs versus everywhere else in the world and the country?
We just opened an office in Europe, so that's new for us. Sarah Cannon joined, and we have a new office there. And we are, I did a seed deal from a group in Singapore recently, so Supabase, if you know them, and so I found and partly, I don't know if I could have done that before COVID. So I'm very hopeful to have yes and, because there was a great ability to meet more companies in a more efficient way. But I think then, you're not just going to have one Zoom, it's going to be far more. And I think there is more travel and there is more, but I am hopeful that it stays broader than just Silicon Valley is my hope, but I don't know. What do you think?
Yeah, talent's universal, opportunity is not. Firms like ours want to be investing in category leaders. We don't check founders' passports wherever they come from. would be thrilled to have a quick 30-minute Zoom conversation and see where the journey takes us. About 70% of the capital that we've raised from our awesome limited partners we invested in the US. We also have an office in London. We're getting more and more excited about India, and we're investing overseas. I don't think Zoom investing is going to go away. Like, it's very efficient.
You think
especially,
you don't?
I don't think so.
Okay,
Especially for like the very first, meeting on both sides. Like, it's great. You want to have like a quick conversation, see if the investor gets it, see if it makes sense, for the investor to spend time with that particular team, and then concentrate on the 3, 4, 5 firms that you really want to raise capital from.
Yeah.
So this is a very efficient, activity right now. So it's not going to go away.
This is also maybe a little bit too esoteric, but I'd also done a story recently on board meetings not happening as much. And I think founders were feeling, I don't know, I think founders are,
Like the board meetings aren't happening?
they're not happening. Or not to the
My
same
board
degree.
meetings are happening.
Are they happening?
Yeah.
Okay, good.
I was like, how do you do that?
I think founders were perfectly happy to sort of be like, oh, it's fine. If you want to skip it, that's okay with me.
Don't skip the board meeting.
Seriously, don't skip it. Because
No, don't skip the board meeting.
It's a great way for founders to use their investors
Yeah.
as the bad caps to organize and rally everybody at the company to get shit done.
Yeah.
It's like
Absolute-
a seriously great way.
Like a deadline it's like, do not miss the opportunity to have a deadline for your team.
Right.
It's like such a way of helping, your board can help you hold your teams accountable. And it's a wonderful opportunity. And
it gives the team useful time in front of the investors, which is, I'm sure,
Absolutely.
very helpful.
Look, it's a lot of work.
it's a lot of work.
Like, this goes without question. And often, people in companies would feel like, oh my God, we have to do this, and we have the
we have it
day
every
job.
quarter. and oh my God.
Exactly. So like it is, painful, but that whole idea of like holding yourself accountable
Yeah.
in front of a group of individuals and firms that invested in your company, it's a very useful idea, because
is
if you could
such
do
good
it again and
hygiene.
again, it's great hygiene.
Yeah.
I also just wanted to ask for the founders and also for your fellow investors in the audience, just about what terms look like right now. So you kind of touched on this a little bit, Nico, but at the later stages, we've been hearing about more and more structure, to sort of replace the down round. If you want to maintain your valuation, that's fine, but we're going to take a bigger piece when you come out of this. Are you seeing that yet in the earlier stage companies? I assume that that's got to happen eventually, or you'll just let them wither? I mean,
Right now, it's a little bit of a game of chicken going on. So we are seeing meeting activity at an all-time high, pretty much, since like late August. And we'll know by the end of October how many of these terrific conversations will result in transactions. The best of my knowledge, I haven't seen companies decide to raise a Series A with like really nasty terms. But of course, we've seen these processes take longer than before. We've seen also, some companies decide to raise like a bridge round if they can't get to the Series A in the short period of time that they would have liked. The bulk of the pain on that topic is to come next year or the year after if the market conditions do not improve. Thanks to the media and all of us getting prepared, a ton of founders made the right call in Q1 and Q2 to downsize. So everybody bought themselves more time. Most of the companies raised a lot of capital in the previous years. So historically, you would raise for 18 to 24 months. Most companies raise for like 36 or 48 months before. So the bulk of the pain, unless there's a crazy strong recovery, is to come up. So at the early stage, I haven't seen any bad terms.
And I think, we all as people want to control our own destiny, and this idea is like, how do I do that? How do I have as much control and outside of whatever is going to happen in the market? And it used to be you needed 12 months of runway, and then it was like, no, you probably need 24, and now it's actually, no, you like 2 is the new 1, 3 is the new 2. So more runway is good. We're seeing a lot of extensions. So same terms, just sort of like extension rounds, and it's like, okay, I'm going to understand how do I maintain my flexibility. And the whole goal is to have that ability to have flexibility so you can experiment and understand like, what does this need to exist in the world? So this is not everybody needs to go and get profitable. I think that's really going to make a bunch of companies do the wrong thing. But it's understanding what does traction and how are you going to be able to really know if you're providing value? Like, what is that? What is that measurement to you? And that's not one size fits all.
It's got to be so hard to innovate when you're constantly focused on not
Yeah, I
running
think
out
it
of
can
money.
make to some weird decisions that you want to be careful of.
It's also not fun. Like if you're like a member of a team that you have to cost budget at all times and you're not the founder or a C-level executive and you're technical, you're thinking about what am I passionate about, what can I moonlight on to get liberated by a visionary VC firm and get going.
Right.
Yeah.
Like this is happening.
But it used to be the answer when capital was cheap was like grow and do it all. And now this ability to like sequence the steps is incredibly important because the resources and the need to like sequence the resources versus do all the things has probably become one of the founders' greatest skills. It used to be how can you hire, attract, and build, and now it's how can you sustain, sequence, and continue the momentum. So I think that's a big shift in the founder's job.
And then, guys, I guess, the bigger question, too, is what are we going to do with all these companies, these many, many, many companies that have gotten funded and have nowhere to go right now? I mean, the exit market is cooked. I don't know if SPACs, I'm curious to know if you guys think SPACs will come back, because obviously a lot of companies went public that way last year. Only something like 14 companies have ever chosen direct listings, which I also think is really interesting that wasn't more widely adopted. But what do we do here? We have a big problem.
Well, we're very fortunate, especially in San Francisco, that there's so many tech companies that are doing really, really well. They have a lot of cash on their balance sheet, and hopefully at some point, especially now that valuation seems to be more rationalized, they will need to innovate through some M&A. So this likely, will happen. In our industry, especially for the large firms like ours, yeah, we want to see some smaller exits, but it's about the enduring companies that really can go the distance and produce a 100x return and pay for the whole vintage, right, or the whole portfolio. So it's an interesting time, what's going on right now in the exit landscape. With the terms rationalizing, I would assume to see more M&A. It's going to come up.
Yeah, it seems inevitable. Also, guys, before we go, just quickly, so Karen, you worked for Mark Zuckerberg for 10, 15 years.
Yes.
He's very focused on the metaverse, obviously. Just wondering if Web3, I know that Cotu's done some crypto. I'm just wondering how you're thinking about that, if that's sort of a bigger area of focus. That was sort of something that was very much in the headlines from, I'd say, like February through June. I feel like I'm hearing that term less and less.
So I did work for Mark Zuckerberg for many, many years. He's like the best boss I ever had. I know there's a lot. He's a tremendous leader, and I learned a ton. I think I work at Cotu, my focus is on AI, open source. I do a lot of enterprise. We do climate as well. That's like one of our main focuses. And so when we think about crypto in the firm, it's more focused on what we see it in terms of payments.
Okay.
So that's how we think about it. And that's like, it's when we're like our focus areas though, are like AI and climate and health and enterprise.
Okay. Yeah, I feel like I'm hearing, again, always about AI.
But
AI.
I had this moment when I was backstage. I remember when Mark spoke here and I was seeing, do you remember that? So we had many interesting, were we at the Ferry Building? Is that where we were? Where it was like, it was very cold and it was really cold. Yeah, okay. There are many stories, I don't know, we could go on that. But like when I started, it was a website, like not even an app. So you can, like a pro tip is like, we went public and it's very easy to remember, when Facebook went public, it had 0 in mobile revenue. And that was a problem. So it's good to also understand, like, even though we stayed private for a really long time, when we did go public, it was this whole thing, and then we had no mobile revenue, and then we had to, in front of the whole world, rewrite our mobile apps and get that right, and then figure out our business model. So
I remember that.
It was certainly, so I guess the moral for that is, like, as a founder, even like super successful companies, they look like they go up and to the right. And from being inside, it always feels like this. Even when you're hopefully going up and to the right, it's like a journey.
Right, absolutely. Well, guys, thank you so much. We're out of time, which stinks. I'd love to talk to you further, but I really appreciate you joining us today. Thank you, all of you, for joining us as well. Appreciate it.
Thank you.
The world is rapidly electrifying.